Welcome to the Deep Dive.
Hello.
Today, we're jumping into the Q1 2025 earnings call for ONDS Holdings, Inc. We've gone through the transcript, the numbers, the Q&A.
Right, the whole thing. Our mission, as always, is to pull out the key stuff, the financials, what's happening with their business units, their outlook.
Exactly. Cut through the noise, get you the crucial details from management fast, so you know what happened and what they think is coming next.
Let's do it. First up, just a quick snapshot of the headline numbers for Q1.
Okay, so reported revenue came in at $4.2 million for the first quarter of 2025.
And from that $4.2 million, they generated $1.5 million in gross profit.
Which works out to a gross margin percentage of 35% for the quarter.
Okay. Profitability-wise, though, still in the red. Operating loss was reported at $10.3 million.
And the adjusted EBITDA loss figure, that was $7.5 million for Q1.
And cash position, how much did they have on hand at the end of March?
They reported $25.4 million in cash as of March 31st, 2025.
Got it. So that's the quick overview. Now let's maybe dig a bit deeper into those financials.
Yeah, that $4.2 million revenue number, it's pretty striking when you compare it year over year. Q1 2024 was only $0.6 million.
Wow. Yeah, that's a huge jump, over 500% increase.
So where did that come from?
Well, if you break it down by their business units, it becomes really clear. The networks segment, that was pretty flat, only about $0.2 million.
Okay.
Almost all that growth, the vast majority, came from their OAS segment, that's autonomous systems. Their revenue went from $0.6 million last year to $4.3 million this Q1.
Right, and management pointed to fulfilling orders from late last year and early this year as the main driver, shipping products, getting services delivered.
They specifically called out deployments in the UAE, didn't they?
He did, yeah, as a key factor there.
And that shift towards more product revenue and OAS, specifically higher margin product revenue, that's really what boosted the gross profit and got them to that 35% gross margin.
Which is a big swing from Q1 last year when they actually had a gross loss.
Definitely a positive shift, although they did caution, that margins might bounce around a bit quarter to quarter for now.
Why is that?
Well, they said it's because they're still pretty early in the adoption phase for these platforms. Plus, they have some fixed costs for their service side, and just the mix of revenue products versus development versus services can shift things around.
Makes sense. Okay, let's look at expenses. Operating expenses definitely went up.
They did, from $8.7 million in Q1 24 up to $11.8 million in Q1 25.
And cash operating expenses. That's usually a better measure of underlying spend.
Right, stripping out the non-cash stuff. That also rose from $7.3 million to $9.0 million year over year.
So why the increase?
They explained it as a deliberate investment, primarily in the OAS segment, adding people, funding programs to actually support and handle that growth they're seeing.
So investing in growth.
Pretty much. And the total operating expense number was also impacted by some additional stock-based compensation expense.
Okay, let's talk cash flow. How much cash did they actually burn through?
Well, cash used in operations actually went down a little bit. It was $6.7 million this Q1 compared to $7.5 million last year. Yeah. They said that was mainly due to better collections.
Okay, but still using cash. So where did the money come from to offset that?
Right. They needed cash from financing activities. They raised about $2.3 million, mostly from things like warrant exercises, where people convert warrants into stock, but also some government grants and other financing bits.
And looking forward, do they expect that cash burn to improve?
Yeah, management sounded pretty confident about that. They expect cash utilization to get better through 2025, basically operating leverage. As that OAS revenue and gross profit keeps climbing, they expect their operating expenses won't grow quite as fast, so more efficiency.
And how do they plan to fund everything going forward? Keep the lights on, fund the growth?
They laid out a few sources, cash on hand, obviously, the gross profits they generate from sales, potentially getting customer prepayments, which they noted is more common on the network side, but it's an option. Proceeds from any more warrant exercises. And then, if needed, they mention having the ability to potentially raise more equity or debt. They have facilities or could do offerings.
All right. Let's circle back to the balance sheet. You mentioned the debt situation earlier.
Yes, the convertible debt. This was a big point. As of March 31st, they had $25.4 million of this debt outstanding.
Which is way down from the end of 2024, right? Wasn't it like $44.6 million?
Exactly, a big reduction. But crucially, it wasn't paid down with cash. It was converted into equity. Debt holders basically swapped their debt for shares in the company.
And that continued after the quarter ended.
It did. On the call, they gave an update saying that number was down even further to $20.6 million outstanding as of the call date due to more conversions in Q2. That included notes that came due in April. Those got converted too.
Okay, so less debt is good, but converting it to equity means more shares outstanding.
Precisely. And that's had a significant impact. They started the year, end of 2024, with about 93.2 million shares out. By the time of the call, roughly 5 months later, that number had jumped to 137.4 million shares.
Wow.
And they clarified, the vast majority of that increase was from those convertible note conversions. That includes things like unamortized discounts and accrued interest, not just the principal amount.
Do we know at what price those conversions happen?
They gave an approximate average around zeros and 68 cents per share. Management commented on this, saying that, market factors, specifically the stock price being low, despite what they see as improving fundamentals, kind of exacerbated the situation. It resulted in more shares being issued than they would have liked.
And there's still more debt left to potentially convert.
Yes, about $23.8 million remaining, including those discounts and interest. They expect that will also convert into shares.
How many shares?
Well, it depends on the stock price. If the price gets above a certain fixed level, they estimate it would take about 18.7 million more shares to clear that remaining debt.
But if the price stays low?
Right. If it stays below that fixed price, there's a mechanism tied to the average trading price, the VWAP, with a discount. That could mean it takes more than 18.7 million shares to retire the same amount of debt. Basically, lower stock price equals more dilution from conversion.
Got it. And speaking of potentially issuing more shares or debt, they filed something recently.
They did. A $225 million shelf registration.
Cool.
Think of it like getting pre-approval to sell stock or debt later if they need or want to. Puts the options on the shelf.
Why such a large amount?
Management framed it as just responsible financial planning, giving them flexibility to invest if big opportunities arise, especially in those huge global defense and security markets they're targeting. They feel the opportunity size dwarfs their current market cap.
But are they definitely going to use it?
They stressed they'd be very sensitive to the cost of capital, the stock price. They want a healthy balance sheet and said creating shareholder value would be the key test for any decision to use that shelf.
Okay, that covers the financials and the balance sheet dynamics. Let's switch gears to the business units. Starting with OAS Autonomous Systems. That was the star in Q1.
Absolutely. $4 million in revenue for the quarter. And they mentioned securing over $9 million in orders just since the year started. That feeds into their growing backlog, which stood at $16.8 million.
And their focus in OAS is?
Pretty clear. Tactical, software-defined autonomous aerial systems, drones basically, but sophisticated ones for U.S. and allied defense customers. They highlighted strong business development, good strategy execution leading to these orders.
And we saw quite a few specific order announcements.
We did. Back in January, an order from a major defense company for Iron Drone integration. That was interesting, testing ground-based threat features. A new use case.
Then 2 initial multi-million-dollar Iron Drone orders from major customers.
Right. And near the end of Q1, that $3.2 million PO from the UAE governmental entity, expanding their Optimus network for public safety, part of a drone box program.
And then more recently, in April, $3.4 million from a European defense contractor, NATO member, for Iron Drone protecting critical sites.
And literally on the day of the call, another $1.7 million order, non-U.S. government customer, Iron Drone again, this time for border security.
So those Iron Drone orders are really piling up.
They are. It's significant because they actually already hit their initial 2025 goal, which was to add 2 new military or homeland security customers.
So they hit the goal early.
Yep. And because of that, they actually raised their target for the full year, now aiming for 4 new customers in that category.
What about their Iron Drone Raider platform? Any updates there?
Big update. They confirmed it's now operational, being used in a live combat environment by a, quote, leading military customer.
Wow, okay. Real world use.
Exactly. And they're saying this is validating it as a best-in-class counter-UAS system, anti-drone tech. They also said this combat validation is driving significant new interest and demand, so they're investing behind expanding that platform.
Okay, that's Iron Drone. What about Optimus? Where's the growth coming from there?
Couple of areas. Expanding with existing customers like that first military user and the UAE expansion we mentioned, but also landing new customers.
Any specifics?
They mentioned securing their first U.S. customer for Optimus back in March. Didn't give details yet, but said more info is coming.
And the markets for Optimus are broader than just defense.
Yeah, public safety, security, homeland security, critical infrastructure protection. They see potential in state and local funding in the U.S., especially for these drone first responder programs that are popping up. Plus the usual federal, DoD, and international homeland security budgets, which they say are increasing and shifting towards autonomous tech.
They also talked about partnerships in OAS.
Right. Two key ones highlighted. First, Palantir Technologies. Integrating Palantir's Foundry AI platform.
What's the goal there?
Initially, using AI to help scale their own operations, supply chain production, field ops. But they also expect it to grow into joint AI product innovation and maybe even joint business development down the line.
Interesting. And the other partnership?
Volada Aerospace. That one's focused on enhancing border surveillance and situational awareness capabilities. They're targeting specific market opportunities and fleet programs together.
So what's the overall OAS go-to-market strategy?
It boils down to offering drone solutions that are functional, proven in the field, reliable, and software-defined, built for really tough operational needs. Targeting those multi-billion-dollar defense and homeland security markets, think border protection, protecting military bases and assets.
How are they reaching these markets?
Scaling up demos globally, building partnerships for local support, integration, sales channels, especially focusing on the U.S. and Europe, and importantly, pushing forward with plans for U.S.-based manufacturing.
And their model for growth in OAS, how do they see it playing out?
It's kind of a two-pronged approach. First, win these big programs of record from governments, then expand within those programs. Second, simultaneously add new customers and new, maybe smaller programs, and then extend those too.
Aiming for a recurring business.
Exactly. Building a base that generates ongoing activity. They really believe this sets them up for a significant growth curve starting now and accelerating into 2026.
Did the Q&A shed any more light on OAS?
Yeah, a few useful nuggets. Follow-on orders after these initial pilots tend to be larger and have significant potential upside. Demand in Europe is genuinely strong, driven by geopolitics near Ukraine. Customers see their stuff as different and valuable.
What about the US Optimus opportunities?
They confirmed it draws from both federal and state local money, highlighting again those drone first responder program budgets. Margin-wise, they indicated Iron Drone has better margins than Optimus, but both are expected to be north of 50%.
Any mention of risks, like tariffs?
They seem to think tariff risk is manageable. They're sourcing away from China and planning U.S. production. Acknowledged maybe a minor potential hit from Israeli tariffs if things don't normalize there, but overall seemed confident.
And customer growth. Manufacturing.
Expecting significant new customer adds in 25 and 26, alongside expanding with current ones. And they stated they have plenty of manufacturing capacity in Israel right now, while actively building out U.S. capacity for the future.
Okay, let's pivot to the other side of the house. The network segment. Much smaller revenue in Q1.
Right, $0.2 million, pretty flat year over year. And the main reason given was just longer timelines for those big 900 megahertz deployments with the Class 1 railroads. Things are moving slower than hoped there.
But there was a major positive development for networks recently, wasn't there?
Huge. On April 11th, their .16 technology got selected by the Association of American Railroads, the AAR, their wireless committee specifically. It's now the standard protocol for the next generation head of train system, or NGH.
And that selection followed a tough evaluation.
Apparently, yes. A rigorous technical review in comparison against competitors. So a big win.
What does that mean strategically?
It's huge validation for their long-term strategy in rail. It positions them really well for commercial adoption, not just in the 900 millihertz band, but also potentially in the 220 millihertz and 450 millihertz bands used by railroads.
And there was related news about the underlying standard itself.
Yes. Just last week, before the call, the IEEE committee formally ratified the 802.16t standard. ONBS and partners were heavily involved in developing this over several years. It's specifically tailored for the needs of private industrial networks like the ones railroads use.
What are the benefits of this 16T standard?
Significant improvements in data throughput and latency, which are critical for modern rail operations. It really cements the role of .16 tech in that NGH system and the whole 900 MHz transition. Plus, it opens doors to potentially use their tech to solve capacity problems in other rail frequency bands like 220 MHz.
So when does this translate into actual sales for the NGH system?
Well, another company, MXV, is finalizing the actual NGH 4.0 specs, expected by year-end. ONBS is already talking to the device manufacturers. They're targeting commercial deployment for the head-of-train devices in early 2026.
And end of train.
Shortly after that.
Okay, so the standard is set. Commercialization plan for 2026. What about the current 900 megahertz deployments that have been slow? Any progress?
Still slow overall, they admitted, but some encouraging signs. Small-scale deployments on critical live networks are happening, and railroads are starting to integrate new IP-based applications over these networks, which ONBS expects will eventually lead to more sales.
Any specific examples?
Yeah, a follow-on order from Metra, the Chicago Transit Authority, working with Siemens. That's for system-wide coverage, due by September 2025. They're also testing PTC messaging integration with customers, said that's going well.
Okay.
They expect another order soon from a Class 1 railroad, also with Siemens, for a full subdivision deployment, which could lead to a wider rollout. And they're working on specific use cases in dark territory areas with no coverage with another Class 1.
What about other frequency bands, like 220 megahertz?
They mentioned executing on a PTC data radio project for Amtrak in that band. Expect deliveries early Q3 this year, with potential for other Northeast Corridor operators to adopt it later.
And IoT solutions.
Yeah, they're talking to several Class 1s about using their tech for data-intensive IoT applications, trying to solve some long-standing data transmission problems railroads have.
So the overall outlook for networks.
Sounds like revenues will likely keep fluctuating quarter to quarter for a while. It just depends on the timing of these projects, especially waiting for the big Class 1 build-outs based on the new standard. Profitability for this segment is really tied to when those widespread deployments finally kick off.
Okay, let's pull back to the big picture. Overall, company outlook and strategy. How did management frame 2025?
They sounded pretty positive, reiterating that they see 2025 as a really exciting time. They feel they're executing well against a clear multi-year growth plan they've laid out.
And the strong start, especially in OAS, is evidence of that.
That's how they presented it, that the foundational work done previously is now translating into real, measurable momentum.
Did they reaffirm their financial targets for the year?
They did, still targeting at least $25 million in total revenues for 2025.
With most of that coming from?
OAS. They expect OAS to contribute at least $20 million of that $25 million minimum target.
And they feel confident they can hit that.
Their confidence, they said, comes from that growing $16.8 million backlog, plus what they described as an expanding and maturing pipeline of customer opportunities. They actually expect the backlog itself to keep growing through the year.
And looking beyond 2025.
They expect the growth momentum to continue, maybe even accelerate into 2026.
So the message seems to be a transition to sustained growth.
Very much so. Management's belief, as stated on the call, is that they're showing they can leverage past investments and enter a period of strong, sustained growth. They wrapped it up by saying they believe 2025 will be a, quote, breakout year.
Okay. Were there any other announcements made on the call?
Just a couple of things. They noted Joe Papo is stepping down from the board.
By that?
He's been nominated to be the U.S. ambassador to the Netherlands, so stepping down due to that. They thank him for his service and said they expect his investment firm will remain engaged investors.
Anything else?
Yeah, they announced plans for another investor day focused specifically on the OAS segment.
When's that?
Sometime in the second half of June. The goal is to give a detailed update on the OAS plan, the financial outlook, multi-year view, and talk about the expanding opportunities they see there. An update from their last one in September 24.
All right. Let's shift now to our final segment, where we try to connect some dots and consider potential futures. And just to be absolutely clear, this is not financial advice.
Absolutely not. Purely hypothetical thinking based only on what we heard in the call.
Okay. So we heard about really strong momentum in OAS, new defense and homeland security wins, expanding programs, growing backlog, plans for U.S. manufacturing. That all sounds positive.
Right. But we also heard about the impact of that convertible debt converting into shares, increasing the share count significantly, especially while the stock price has been low. Management believes good execution will drive the price up, making future financing less dilutive or enabling it on better terms.
So there's this tension between operational momentum and financial structure.
Exactly. So let's play out an outrageous but plausible scenario. Again, hypothetical. What if that OAS momentum accelerates even faster than their current guidance suggests?
How could that happen?
Well, think about their comments, targeting more than 2 new major customers this year. Iron Drone, now proven in combat, driving new demand. Pursuing big U.S. opportunities, Optimus for first responders, potential U.S. manufacturing for Iron Drone. What if they land a really substantial, maybe multi-year program of record? Or a massive fleet order from someone like the U.S. DoD or a major NATO ally for counter-drone or border security tech?
And if that happened much sooner or was much bigger than expected?
Right. If an order like that landed, significantly larger or earlier than what seems baked into the current $25 million guidance and $16.8 million backlog, well, that could completely change the story.
How so?
It could dramatically accelerate the revenue growth, maybe push OAS towards profitability much faster. News like that could, hypothetically, be a major catalyst for the stock price.
Okay, so a big contract win could drive the stock up.
Potentially, yes. And if the stock price moves up significantly, a few things could happen. First, any remaining debt conversions become less dilutive, takes fewer shares to pay off the same debt amount. Second, it might allow the company to use that $225 million shelf registration or other financing options at a much better valuation.
Giving them more capital, on better terms, to fuel even more growth or maybe make acquisitions, like management hinted they might want flexibility for.
Exactly. It creates strategic options. So how might someone speculate on that possibility? Again, not advice.
Okay, let's hear the speculative, non-financial trade idea based on this hypothetical.
One way, purely as a thought experiment, could be buying some out-of-the-money call options that expire later this year.
What's the thinking there?
It's basically a bet. You're betting that one of these major positive catalysts, a huge contract, maybe does materialize relatively soon and causes a sharp upward spike in the stock price before the options expire.
And the risk.
The risk is defined and potentially total. You pay a premium for the options. If the catalyst doesn't happen or the stock doesn't move up enough or doesn't move up fast enough, those options likely expire worthless. You lose the entire premium you paid.
So it's a small, defined risk for a potentially large reward if that specific, favorable, and maybe low probability outcome actually occurs.
Precisely. High risk, high potential reward speculation. And it's crucial to understand the very high likelihood of losing the investment if things don't play out exactly right.
Okay. Again, just illustration of speculative thinking based only on the call content, connecting operational dots to potential financial outcomes and strategies, fully acknowledging the significant risks. Not advice.
Definitely not advice, just connecting those pieces from the call.
And that wraps up our deep dive into the ONDS Holdings Q1 2025 earnings call transcript.
We've hit the key financials, the updates and outlook for autonomous systems and networks, the whole debt conversion and capital structure story, and upcoming events like that OAS Investor Day.
As always, our aim is just to pull out the essential facts and perspectives shared by management in the call so you can get up to speed quickly and thoroughly based on the source.
So take these insights, filter them through your own lens, and decide what they mean for the company and its place in the market.
It really feels like a story of two competing forces right now. The undeniable momentum and potential in their autonomous systems business versus the financial headwinds from the capital structure changes. Which narrative wins out will be fascinating to watch.
Indeed it will. Thanks for joining us for this deep dive.